two types of options, puts and calls. Each represents the opportunity, not the obligation, to buy or sell 100 shares of a given stock or tradable security by a specific expiration date at a specific strike price for a specific premium, or effectively the cost of the option. Let's imagine a hypothetical scenario where you are bullish on Apple stock and it is trading at $90 a share, and you buy a $100 strike price Apple call option for the end of the month. Let's imagine that the Apple stock goes up to $110 by the end of the month. Your hypothetical profits would be at the $110 levels. This would mean that you could buy from your call option 100 shares of Apple at $100. That's what you bought the right to when you bought that call option. Now, at the end of the month, if it goes up and it's at 110, your profit is the difference from $110 to $100 times those 100 shares, right? So 10 times 100, $1,000 minus the premium or the cost of your call option. So if you spent $50 on it, you would have made $950. So in this case, you got a multiple to the underlying Apple stock going up, and you didn't risk as much money as owning, 100 shares of Apple, in this case, which would have cost $9,000. So that's one example of buying a call. Now, the seller of the call, right, he sold the call when Apple was trading at $90. Now it's trading at $110. This means that he has to sell 100 shares of his Apple stock to you at $100 by the expiration date. So effectively, he made money from the premium from selling his call option. Now, the issue for him is that he gave up on $10 a share in gains, so he effectively capped his return at $100 a share, whereas he could have got another, he could have sold his shares at $110. So he didn't maximize his profits, and the person who bought the call in this instance made money. Now, if he had sold the call and Apple hovered at $99, $98, at the end, the option would have expired out of the money and the call would have been worthless at the end of the September expiration. So in this instance, the call seller was the one who made money. Now, it's important to realize that the underlying stock options price, or the premium, what it's worth, is a measure of volatility and how much time there is towards expiration. So if it's a very volatile stock, options are worth more. If it's a slow moving stock that moves up or down 0.5% a day on a regular basis, the stock option will be worth less. Similarly, if you're trading stock options around earnings dates for stocks, that's when you see some of the most volatile moves. That's when stock options are priciest leading up to the events, because there's a large degree of volatility priced into those option contracts. Let's go through a hypothetical scenario in which you are bearish, or you think a certain stock price is going to go down, and you want to buy a put to capitalize on that. Let's use Apple as another hypothetical example, and the stock price is currently trading at $90. It's not, but in our example, it will be. And you want to buy a $50 strike price put for the end of the year. Now, let's imagine for some reason the price of the Apple stock tanks to $40 a share on the open market. What this means is your put option, you bought the right to sell 100 shares of Apple stock at the $50 strike price. So when the market price of the Apple stock is $40, you could effectively buy 100 shares of Apple stock for $40 and then you have the right to sell them at $50 because of your put option. So in this case, you would profit the difference of $10 a share times your 100 shares minus the premium or the cost of the option. Now, in this scenario, your option was probably pretty cheap because it was very out of the money. And even though it was a longer time horizon, which does drive up the price of the option because there's more opportunity for a volatile price action to happen, it's unlikely that this was an expensive option, so you probably made primarily profit on this trade. Now, on the other side of the trade, the put seller. This means that they sold the $50 put. Effectively, when you exercise your option and you choose to sell at the $50 price point, which you would only do if the option and the security was trading below $50, this person effectively is buying 100 shares of Apple at the $50 price point. So, in some scenarios, if you want to get shares of a specific, stock, you think it might go down further and you're comfortable at a specific price level, you can sell a put on the underlying security, and then if it goes down, you collect your premium or the cost of the option you sold, and you get to become a holder at the specific price level. Now, if it tanks, you're out of luck, but can be a good strategy to accumulate shares and get some premium. The most important thing to keep in mind when trading options is implied volatility. Your options price will be directly correlated to the perceived volatility in the stock price. That's highest, towards earning events where companies publish their quarterly results. They say how they're doing through the last quarter. It'll give guidance for most companies. And you can see large moves in the stock price as people buy and sell the stock based off of what the company did and what they're saying as far as future results. And so, anytime you're buying options, you want to be aware of situations where the implied volatility can go down, and similarly when it can go up. So, always very scary to trade options around earnings because even if the stock price moves in the direction you want it to, the volatility might be much lower post earnings and the option price will evaporate. Similarly, duration. If you want to trade short term, calls, puts, options, those can move against you very fast. There is sort of the intrinsic value of the options. So as you get closer to expiration, there is a natural decay of the price of the option because there's less time for the value and for volatility to come out. And so if you buy an option and even if you get the move right, you're bullish, you buy a call and the stock price starts to move up, you have to be aware of that as you move closer to expiration, there will naturally be decay in the value. Now, it going up will help the price, but that's something you want to be aware of. In some instances, you can buy leaps, which are, long dated calls or puts, usually like a year or 2 years out, depending on the specific stock and whether that's, a tradable option. But those are the basics. You can make a lot of money trading options. It's very casino-like, degenerate, but you can also lose a lot of money. So definitely something to look at carefully if you want to implement. And always just don't risk more than you can lose. Do it responsibly, and if anything, watch how option price change over time before you hop in because you can burn yourself very quickly. Now, let's swap to some real examples using the Robinhood trading interface. Now, I'm not a big fan of theirs, but on options, their user interface is great. Let's start here. All right, so let's look at options on Robinhood. Let's start off and look at Google. Very large, popular company, trading at 165, and let's look at the options. So right now it's showing us the options close to the current stock price. We're looking at buying calls, and you can see right now we're looking at a September 6th expiration date on the option. Let's push that back a bit. Let's look at December 20th options. How about the $160 strike price? It's very close to our current share price. You can see, right, the bid, people are bidding $13.60 for it. Option sellers are asking for $15.80. In the middle of those two marks is $14.70. We're saying that currently there's about 3,400 options of this particular strike out there and date, and the implied volatility is pretty low at 30%. Let's add it and look at how this option has traded historically. In the last trading day, you can see it was relatively flat. End of day, there was a spike as there was a lot of buying and Google went up, as did most of the market at close. So a 10% close after being flat all day, pretty impressive. Now, if you look at the last month for this Google 160 call, you can see we started off pretty hot. We've come down way down. There was a bottom at August 14th at 12:30, and we went all the way back up to 1788. So that's a pretty big change in the option price. So it'll be interesting to see what the underlying change was to the Google stock over that same period. And if you look at it, you can see it was trading in the 170s. We got down to around 160. And then when we got up to around 170, it's about a 5% move in the stock. You saw that, relative outperformance on the option. And so that's what options do. All right. We just looked at a call. Let's look at a put. I'm going to choose a stock that I own in my personal portfolio, App. It's called App11. It's a mobile marketing platform, 31 billion market cap, and much smaller than the 2 trillion market cap that is Google. So let's look at app options. We're still looking at September 6th expiration here. We're going to buy a put. You can see the current share price is 93.36. And so let's look at this $90 put and see how that looks. You can see right now much less open interest. So there's only 27 instances of this particular strike and security. So the $90 September 6th puts, there's only 27 of them that have traded hands effectively. The bid, there's currently 77 bids at the 70 cents price mark. Again, in options, nomenclature, 70 cents means $70 because all options are in increments of 100 shares. So that's 70 times 100. Option put sellers are wanting to sell 108 at the $80 strike limit. And so that's a 10 cents difference. And so the mark at that 75 is where the trades are currently being executed at. The implied volatility, a bit higher than the Google one, not crazy. Let's look at this and see how it's performed. Apt $90 put for September 6th at 75 cents. Currently, that's the between the bid and ask. Today, one as high as $1.50, and then we're all the way down to 68, 75. So basically these options were cut in half from 9:50 to 4 p.m. Now let's look at them over the last month. So on August 5th, around noon, you could have sold a few of these options for $2,400, right? Now, this was around the earnings date, and the stock price went down, and the market was going down, and so this was effectively the peak. And so if you bought these here and held, well, if you look at this chart, you're in for some pain. It peaked from $24 a share, which is 2.4K for the whole contract, all the way down to the 75 cents we're at currently. So that is a massive, degradation in value. And let's look at the reason for this. Let's look at the last month stock price. So you can see here we're trading in the 70s, down to 69, 66, 67. Then they had earnings. Stock price went up, and that's that $90 put. We're currently trading at 93.66. So effectively, it went from deeply in value, where you could, you at a $67 price, very much in value, and now we're above the $90 strike. So right now the option is worthless unless by September 6th we go back down. So you can see if you sold the options here, you made a lot of money. If you bought them and held, you got slaughtered. And it was really just because the stock price went up, because of a positive reaction to earnings, the underlying put holders got slaughtered, and people who sold the options came out very well.